Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Mobix Labs.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you trade stocks, crypto, forex, gold, or indices and want clearer buy and sell signals, you can check out VIP indicators through my link below. Grow $100 to $10 K with VIP indicators. VIP indicators offers TradingView indicators, market alerts, trading education, and chart reading support with up to a 93% win rate. The tools are designed to help traders spot possible setups faster and trade with more confidence. But please remember, trading is risky. No indicator can guarantee profits, and growing $100 into $10 is not guaranteed. Use these tools for education and analysis only, manage your risk carefully, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
Okay, so let's unpack this a bit. Today, we're diving into a massive stack of financial reports, non-binding letters of intent, and defense M&A filings.
Right. A lot of heavy paperwork on this one.
Yeah, definitely. And we're basically trying to answer one very specific question here.
Grr.
Can a tiny, highly volatile microcap stock successfully maneuver to become, the backbone of the U.S. military's sovereign supply chain?
Which is a massive, massive undertaking.
Oh, absolutely. Because, on the surface, when you hear the phrase microcap stock, your immediate reaction really should be extreme caution.
Right. We usually picture like penny stocks, massive price swings, day traders staring at 5-minute charts hoping for a quick flip.
Exactly. But what we're looking at today with Mobix Labs is a company that's actively attempting to shed that identity. They want to entirely re-rate themselves.
Yeah, they aren't just trying to be some niche semiconductor supplier anymore. They are aggressively maneuvering to become a defense and AI infrastructure powerhouse.
Right. And when you look at their strategic shifts over the past year, they're positioning themselves at the very center of some of the most critical, high-stakes supply chains in the world.
We're talking military-grade infrastructure here.
Yeah. And the mechanics of selling into the defense sector are fundamentally different than, say, just selling consumer electronics components to a commercial retailer.
Oh, totally. The barrier to entry is astronomically high, but the reward is permanent placement in a multi-billion-dollar ecosystem. All right, let's move into the wealth-building context.
Which is an incredibly important pivot because, how does an early-stage, aggressive microcap fit into a sensible long-term wealth strategy?
It's a fair question. To a lot of people, building a portfolio, relying on a company this small feels like
walking a high wire without a net.
Exactly. Because typically when we talk about generational wealth building, we point to massive blue chip companies with decades of predictable dividends.
Right, the safe bets.
Yeah, and the skepticism here is completely warranted. But true wealth building also involves identifying massive macroeconomic tailwinds early, like long before the broader market prices them in.
And right now, there is perhaps no bigger macro tailwind in the industrial world than the push for U.S. onshoring.
Right.
The creation of sovereign supply chains.
Precisely. The defense sector has realized it can no longer rely on foreign, potentially adversarial supply chains for the raw materials and components that power advanced AI drones or next-generation missile systems.
They literally can't risk it.
Right. The government essentially mandates that these critical components be built at home, safely away from any geopolitical friction.
And Mobix Labs is capitalizing on this through what's known as a roll-up M&A strategy.
Yeah.
For you listening, a roll-up strategy is when a company acquires multiple smaller, specialized businesses in the same industry, right? And merges them into one larger entity.
Because the defense contracting market for Tier 2 and Tier 3 suppliers is incredibly fragmented right now.
Yeah, you have hundreds of tiny mom-and-pop engineering firms making one specific widget.
Exactly. And Mobix wants to consolidate that fragmented market to build a one-stop shop defense mode.
But consolidating a market requires immense capital and absolutely perfect execution. It still feels like a massive gamble for a long-term hold in a retirement portfolio, doesn't it?
Well, think of it like buying up individual toll booths on a brand new multi-lane highway.
I like that.
At first, you're just bleeding cash to acquire the land, pour the concrete, and build these little booths. But eventually, you own the entire road.
Right, you control the flow.
Exactly. The key here is the stickiness of defense contracts. When you lock yourself into decades-long defense platforms, which is exactly what they are doing, that long-term cash flow becomes nearly guaranteed.
Because the military isn't going to just swap you out.
Right. The strategy is not about maximizing what they earn this quarter. It's about owning the underlying infrastructure that the military will be forced to use for the next 30 years.
Now let's look at the fundamentals. Because if you want to buy up all those toll booths, you need capital, and you need to actually execute the construction.
Right. You need cash.
So let's look under the financial hood to see if they have the runway to survive this building phase. In fiscal year 2025, they hit $9.91 million in revenue.
Okay.
That is up 53.87% year over year. That is an undeniably strong top-line growth metric.
Yeah, and that revenue growth is being driven directly by deep penetration into those exact defense, aerospace, and critical infrastructure markets we just discussed.
Right.
It's a massive inflection point that proves their product actually has real demand.
True, but the net loss was a negative $46.13 million.
Ouch.
Yeah. That is a 122.9% increase in losses year over year. That's a massive hole on the balance sheet.
It is.
For anyone listening, a roll-up strategy that relies heavily on outside capital to fund a $46 million burn rate is inherently dangerous. Like, if that capital dries up, the entire strategy collapses overnight.
The headline net loss is definitely terrifying, but if you look closer at the mechanics of that loss, it masks a very powerful operational turnaround that happened in the second half of the year.
Okay, how so?
Well, much of that $46 million went into the upfront costs of acquiring companies and expanding infrastructure. If we look specifically at Q3 of 2025, their adjusted gross margins hit a record 60.6%.
Wow, okay.
Yeah, that's up substantially from 42.7% just the prior quarter. And simultaneously, their adjusted operational losses narrowed dramatically to $1.17 million.
Meaning the actual cost of producing their goods is dropping significantly.
Exactly.
They're keeping 60 cents of every dollar they make before operating expenses, even if corporate-level M&A spending remains high.
Right. And management stated long-term targets are a 60% gross margin and a 30% operating margin. Hitting that 60.6% gross mark in Q3 really validates the viability of their entire thesis.
And what drove that jump?
The primary driver was the successful integration of Rage Systems, which is one of their recent acquisitions. As they shift their revenue mix away from lower-margin commercial goods and toward these high-margin defense programs, the unit economics become highly profitable.
Okay, sure, the drywall is up, so to speak. But they are paying for that drywall with a high-interest credit card.
That's a fair point.
Because I'm looking at the balance sheet funding this, and they are relying heavily on a $100 million equity line of credit from B. Riley, alongside a recent $6 million oversubscribed public offering.
Right.
Their free cash flow is still deeply negative. They are surviving purely on outside money to fuel this M&A strategy.
Let's expand that house renovation metaphor. It looks like a massive, terrifying money pit right up until the drywall goes up and the kitchen is installed.
Yeah.
That 60.6% gross margin is the drywall going up. It shows the foundation is solidifying. And the reason those margins can stay permanently high is the extreme regulatory barrier to entry in the defense space.
Walk us through what that barrier actually looks like on the ground.
Getting a component certified for military or commercial aviation takes years of rigorous Department of Defense vetting.
It's not a quick process.
Not at all.
Yeah.
You have to pass AS 9100 aerospace certifications, endure extreme stress testing, navigate mountains of federal compliance. It's an exhausting, expensive process. But once you survive it, and your component is officially designed in to a platform, like the Boeing 737NG or the U.S. Navy Tomahawk missile, you are almost never replaced.
Because the switching costs are insane.
Exactly. Prime contractors like Boeing or Lockheed Martin will not switch to a cheaper competitor to save 5 cents on a microchip, because recertifying that new chip would cost them millions of dollars and years of delays.
That makes sense.
So that dynamic creates near-permanent, high-margin revenue. That brings us to the catalyst timeline.
Because if the fundamentals show a company spending aggressively to build an impenetrable moat, you and I need to know what specific events in the next 3 months will actually prove this strategy is working.
Right.
Earnings just passed on May 14th, 2026. So the market has fresh data confirming they held that 60% margin. But what else is actually on the horizon to move the needle here?
The most massive potential catalyst sitting right in front of us is a non-binding letter of intent, or LOI, to acquire special project delivery.
Okay, tell us about them.
This is the move that directly secures those U.S. rare earth sovereign supply chains. Rare earths are the essential minerals needed for everything from F-35 fighter jets to advanced drone optics.
And historically, this supply chain has been overwhelmingly dominated by overseas markets.
Exactly. By acquiring a company dedicated to securing domestic delivery of these materials, Mobix Labs makes itself indispensable to the U.S. government.
I have to push back here, though, for the sake of anyone thinking about investing based on that news.
Yeah.
An LOI is essentially a corporate handshake.
Sure.
It's entirely non-binding. It is not guaranteed revenue, and M&A deals fall apart in the due diligence phase all the time. You cannot value a company based on a handshake.
Your caution is absolutely correct there. But the LOI isn't their only iron in the fire. They also have an unsolicited proposal to acquire Peraso at a 53% premium, with active discussions ongoing.
Okay.
And beyond acquisitions, their Smart Munitions anti-drone feasibility program is currently transitioning from the testing phase into actual production contracts.
Which is huge.
Yeah. Given modern defense requirements, anti-drone technology is arguably the single most sought-after capability in the military world right now.
But again, we are talking about proposals and feasibility programs. It feels like a lot of plates spinning in the air, but not a lot of actual food on the table yet.
In the defense contracting world, you don't need every single initiative to land perfectly. What matters is the sheer volume of shots on goal management has engineered.
Okay, I see what you mean.
If even one of these massive macro catalysts hits, if the anti-drone program secures a fleet-wide production contract, or if the rare earth acquisition officially closes, the stock re-rates entirely.
Right.
The market will instantly reprice the company based on that new, guaranteed 30-year revenue stream.
Now let's pivot to the chart.
Yeah, let's look at it.
Because with all these catalysts hovering, we have to look at how the market is actively trying to price these potential events in real time. And currently, the stock is exhibiting severe breakout momentum.
Oh, yeah.
We're seeing it gap up on unusually high relative volume in Thursday's session, which means institutional algorithms and high-volume traders are starting to take positions.
That volume spike tells us the market is waking up to the corporate action. This isn't just retail traders playing with pennies on message boards, you know. This is a structural shift in how the stock is valued.
Right.
If you look at the stock's history, it has a documented pattern of violent upside re-ratings based on news flow. Like when the Tomahawk missile integration news dropped, the stock surged 532.77%.
That's wild.
And when the anti-drone program was initially announced, it spiked 22.82% almost instantly.
But here's where the mechanics get really interesting and also where investors need to be incredibly careful. The beta on this stock sits at a negative 0.07.
Yeah, that's a tricky number.
For you listening, beta is a metric that measures a stock's volatility relative to the overall market.
Yeah.
A beta of 1 means a stock moves perfectly in sync with the S&P 500. A negative beta usually implies the stock moves inversely. Like if the market goes down, the stock goes up, acting as a hedge. But a negative 0.07 on a microcap is extremely deceptive.
Very much so.
It doesn't mean this stock is a safe hedge or smoothly uncorrelated. It means the stock lies completely dormant, highly illiquid, and ignores the broader market entirely for long stretches of time.
I like to describe that kind of beta profile as a geyser.
A geyser, okay.
Yeah, it's completely still on the surface for months. You look at the chart and think absolutely nothing is happening. The daily trading volume dries up, but the pressure is building underneath the surface.
While the M&A deals are being quietly negotiated.
Exactly. The defense contracts are undergoing classified testing. And then, without warning, a catalyst drops and forces a violent 500% eruption. That dormant then explosive cycle is exactly what that negative beta represents in a microcap like this. So what does market sentiment look like?
Well, if the chart is gapping and erupting, we need to define exactly who is buying the stock right now and what narrative is driving their flow. Currently, sentiment is aggressively bullish.
Very much so.
The broader narrative is shifting hard from viewing this company as a speculative, high-risk gamble to seeing it as a critical infrastructure play.
The financial headlines are certainly dominated by the Boeing 737 and G orders and that rare earth LOI. The market is deeply in love with the idea of sovereign supply chains right now.
Oh, absolutely.
But here is the most fascinating detail buried in the research. Currently, there is zero institutional Wall Street analyst coverage on Mobix Labs. Zero.
And that is exactly why this stock is so volatile. Zero Wall Street coverage means the current price action is almost purely retail and event-driven.
Right.
Retail flow can be incredibly fickle. The moment momentum stalls or a news cycle goes quiet, retail traders get bored and move on to the next shiny object.
It happens all the time.
Yeah. Without the guardrails of institutional money holding core positions, the floor can drop out from under the stock price incredibly fast.
I look at that lack of coverage from a completely different angle, actually.
Really? How so?
Finding a defense contractor that is actively securing U.S. Navy deals and Boeing contracts before Wall Street initiates coverage is exactly where long-term alpha is generated.
Oh, I see.
By the time analysts at Goldman Sachs or Morgan Stanley start issuing formal price targets and institutional money flows in, the massive re-rating has already happened.
The retail investor is usually the last to know.
Exactly. But in this rare case, the opportunity is available before the institutions arrive. Furthermore, the insider confidence is already there, loudly signaling what management expects to happen.
What are the insiders doing that signals that?
Well, they're actively tapping that $100 million credit line. They successfully went to the market and raised the $6 million in equity. And they just hired a veteran defense general manager to dramatically expand their physical manufacturing facility.
That's a big move.
Corporate insiders do not deploy that kind of massive capital or hire top-tier defense talent to build out factory floors if they don't believe the production contracts are imminent.
Now let's talk about the risks.
We have to.
Because before we issue any kind of final verdict on a stock with a history of 500% violent upside eruptions and zero Wall Street coverage, we have to clearly define what could destroy this entire bull thesis.
Absolutely.
First and foremost, if you hold shares in this company, you face massive dilution risk.
It is the absolute elephant in the room for any microcap.
Right. They are funding a highly aggressive M&A strategy through that $100 million equity line of credit, or ELOC from B. Riley.
Yeah.
For you listening, an ELOC isn't traditional debt like a bank loan. It means Mobix Labs essentially has the right to sell their own newly created stock directly to B. Riley, usually at a slight discount to the current market price.
Right, which can spiral fast.
Exactly. If the stock price drops, and Mobix still needs to pull $10 million from that line of credit to fund an acquisition, they have to issue exponentially more shares to get that same dollar amount.
Yeah.
That expands the total float and heavily dilutes your specific slice of the pie, effectively wiping out your equity value in what we call a dilution death spiral.
It's the ultimate catch-22 of microcap growth. You desperately need the outside capital to build the toll booth and secure the moat. But the mechanics of raising that capital can drown the early investors if the stock price doesn't appreciate simultaneously.
And then there's the execution and integration risk. We discussed their roll-up strategy earlier.
Yeah.
Roll-ups are notoriously difficult to pull off in the real world. You are buying different companies with different corporate cultures, different human resource departments, incompatible accounting software, and completely disparate tech stacks.
It's a logistical nightmare sometimes.
You were trying to force all these distinct entities to work together seamlessly.
And if that LOI for special project delivery collapses during due diligence, a major pillar of their sovereign supply chain narrative disappears instantly.
Exactly. Integrating semiconductor manufacturing, AI, drone software development, and rare earth element mining under one single corporate roof presents immense, almost unfathomable operational challenges.
Oh, yeah.
It can very quickly turn into a Frankenstein monster of disconnected, inefficient businesses if management fails the integration phase.
I can see the execution risk is incredibly high. It is a
Yeah.
monumental task. But we also have hard evidence in the financials that management knows what they are doing.
From the rate systems integration.
Exactly. Look again at the recent acquisition of Rage Systems. They integrated that company successfully, streamlined the operations, and it immediately boosted their overall gross margins to that record 60.6%.
Which is impressive.
They've proven on a smaller scale that they know how to sew the distinct pieces together and actually extract operational value, rather than just blindly acquiring top-line revenue for the sake of growth.
It makes you wonder, as global tensions require rapidly modernizing defense requirements, how many other unknown microcaps are quietly trying to buy up the toll booths of tomorrow's defense infrastructure while Wall Street is looking the other way?
So with everything on the table, what's the final verdict?
Well, when we synthesize the high-growth catalysts, the very real fundamental turnaround in their gross margins, and weigh that against the massive looming dilution risks inherent in their funding
Oh,
structure.
yeah.
Well, the research gives us a bullish score of 7 out of 10.
Okay, 7 out of 10. And the long-term view here is a speculative growth hold for the next 6 to 12 months.
Right.
That is the exact timeline required to see if these massive shots on goal actually find the net. We need to see if the smart munitions anti-drone programs mature from testing into signed multi-year production contracts.
Yeah.
And we need to see if the pending acquisitions for Special Project Delivery and Paraso actually close and begin generating unified revenue.
And most importantly, that 6 to 12-month window will validate whether that operational shift toward a 30% operating margin is a permanent structural change in the business model or just a one-quarter anomaly.
It all comes back to that house renovation metaphor. You have to decide if you're willing to hold your position through the messy, expensive, highly volatile drywall phase, trusting that the finished defense infrastructure they are building will be worth the stress.
And if you want extra help reading trading charts, you can check out VIP indicators through the link below. The campaign is grow $100 to $10 to 10K with VIP indicators, and their tools include TradingView indicators, market alerts, and trading education with up to a 93% win rate. But trading always carries risk, and no profits are guaranteed. Use the tools for education and analysis, manage your risk carefully, and always do your own research before making any trade. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.